I'm recording this episode for you today, the business owner, the entrepreneur, the real estate investor, the real estate broker, because the economic data is changing right in front of our eyes. This tariff war has escalated, and the odds of the recession are coming. And I want to chat with you about what you should be paying attention to and how possibly this might get us to 0% interest rates.
Welcome to the Anton Stentner podcast, and today we're talking about how Trump tariffs are actually worse for the economy than you think, and of course, how's that going to affect real estate? That's a real question. Tell me what's going on, and why it's worse than people think.
What we're starting to see is those early signs of demand destruction. You're seeing early signs of deflation. You're seeing these tariff impacts ripple through the dollar, through the 10-year treasury. It's essentially creating this powder keg inside of the U.S. economy where our GDP is shrinking, inflation has been sticky, tariffs are exploding, and the Fed's backed in one corner saying, we're not going to cut, while everyone's lobbing stones at the Fed saying cut. And so I want to unpack like what we're seeing in the headlines and kind of give everyone an idea, and also tell everyone, I want you to be really paying attention to economics over the next 60, 30, 90 days, because this is so volatile that it has the ability to push the economy one way or another. It's like a boat in a raging river, and you bump into the rock, but the tide is pushing you somewhere. That's really what's happening right now. And so we're going to have to just pay attention. Then I want to give people some ideas on what you should be doing and then also how to take advantage of this.
Got it. Well, let's just start with this first question. What is demand destruction, and why should people care about that?
So demand destruction is essentially what tariffs do. In economics, demand destruction refers to a permanent or sustained decline in the demand for certain goods in response to persistently high prices or limited supply. A tariff is exactly that. It forces prices to be higher, it forces the limited supply, and so it starts to destroy demand. Then what happens is consumer behavior may decide, oh, that's not worth purchasing. They may reallocate the money somewhere else, or they just start avoiding it or seeking out substitutions and alternatives. And then that leads into deflation.
Which I guess that's the next question. What is deflation for people to know? I'm assuming it's the opposite of inflation, but
Yes.
Explain why deflation is so bad, because some of us actually like paying less for our steaks than paying
Whenever
more.
we get to deflation, the warning bells are going off in the economy, and the Federal Reserve has to cut because there's some economic catastrophe. When you're a consumer-based economy, it's based on consumers consistently purchasing and pushing prices up in a sustained manner. That's why they have the 2% inflation target. But deflation is where in economics, there's a general decline in the price level of goods and services over time. And it means that you can purchase more. And you can purchase more services, and you have more purchasing power. And it's the opposite of inflation. But deflation comes because the economy has just been struck by a torpedo, and the whole machine is taking on water and it's sinking. So if that happens, you'll know that, oh my goodness, this problem is getting out of control. So yes, prices go down. But deflation, while seemingly good, while seemingly beneficial, is bad because what it leads to this vicious cycle of declining spending, declining investment, and declining economic activity. And then you get lower wages and you get higher unemployment. And so that growth just starts to stall out. Understand that our economy is like most modern airplanes. It can only glide for a while, but it glides and it goes down. It takes thrust, gas, and the prop or the engines pulling really hard to keep it moving in an upward direction. Deflation cuts the engine of the economy. That's what actually happens. So when people pray for prices to fall and prices to go down, be careful what you wish for. This is one of those cautionary tales.
Yeah, that's why typically in a healthy economy, you don't ever see prices go down. Most likely will go up. You know, the real question is how fast. But yeah, if you think about it, we've never seen prices ever go down except one time, and that was during the Great Recession, which was really bad. And like the house prices going down actually caused the crash.
Bingo. That should be the example in everyone's mind of deflation. We did see deflation during the Great Financial Crisis, and you did see deflation a little bit in the early 80s. But the big deflation in the last 40 years is the Great Financial Crisis. Why was that? It's because everything was broken. So we really got to be careful what we wish for. One thing I want to kind of look at here is that if you have demand destruction, you have to realize that people's disposable income is tightening and they're looking for alternatives and they're going to be purchasing less. So Amazon really made that clear over the last, week or two. And I don't know if the headlines were real or the headlines were fake, but it said Amazon is publishing the cost of tariffs to their website. Trump administration gets their panties in a wad, and I agree. If I was Amazon, I would have done it because you're making it transparent how much these tariffs are costing in particular. But what we're seeing is demand already slow down. We're seeing the start of demand destruction in front of us. And it's from this silent tax, and this silent tax is tariffs. For people that don't understand, I want to just break down the idea of a tariff real quick. A tariff is you're going to buy a phone. And if this phone comes from China, you know that there is now 140% or whatever the number is on top of that. So if this phone's $1,000, that means this phone is $2,400 to purchase after the tariff.
If it's 100% tariff.
If it's 140%. And because the tariffs are so high, I was at a local business last week here in Everett. And I love working out, and they sell workout equipment. And I was chatting with them, and they import a lot of their workout equipment. I walk into their warehouse, and it's a big warehouse, probably 12,000 square feet. It's stacked with boxes. And I say to the owner, because I know him, because I bought a lot of equipment from him over the years, and he's just in the community of people who like powerlifting and CrossFit and the hardcore gym rats. I said, Anthony, what's it looking like? And he goes, well, we canceled all of our orders. I said, why? He goes, well, a container used to cost, 30 grand, and those same containers are going to cost between 80 to 100. And I go, well, that doesn't work. He goes, absolutely it doesn't work. He said, what you see in the warehouse is what we got. And he said, it's going to be like that until tariffs change. I said, well, what do you think is going to happen? He goes, sooner or later, the consumer is going to be pissed off because they can't buy what they want. They're going to look for alternatives, and then the economy is going to start massively slowing down because if they can't purchase something or what they want and purchase it at an affordable price, then things will slow down. I said, you know what? I really agree. He was slightly more pessimistic than my view. I'm just a natural optimist, but really interesting to see firsthand a business who said, I have killed off 4 containers full of stuff from China, and I'm not purchasing any more right now.
I think that leads us into the other problem that this is creating. I recently saw an image on some kind of like news report where they were showing all the boats in the Pacific Ocean and where they're located. Normally this wouldn't even be a thing you would care about, but boats go from, Asia to the United States and back to Asia, and they're all over the place, but it's usually all over the Pacific Ocean. All the lights were super heavy, like 80% parked in China. Yeah. Because they're not leaving because the orders are being canceled. So exactly what you said is like times that by thousands of orders. And what's
hundreds of thousands.
Yeah. And so I guess, let's get into it. Like what is happening there and why should people care about it?
See, we're working our way through the dominoes here, right? So you've got this inventory glut and shipping chaos. And, you really just mentioned it. So importers knew that tariffs were coming. And because the tariffs were coming, we had a glut that was front loaded through March. You saw inventory ratios grow and you saw GDP, look pretty good. Even though the Atlanta Fed was calling for a huge negative number, you saw people front load that. But now global container rates, like you're saying, are trending down. Shipping rates are getting cheaper because there's less items being shipped. So what this does is this starts this domino, and I wrote out the domino, so I'll go to the domino right now. I was going to mention this later, but this is the perfect time. My dad was a longshoreman, and so I have not like a ton, but slightly paid attention to cargo my whole life because that was his livelihood, and him and I would talk about it. And so what happens is you had a glut of inventory come in first quarter. You had Liberation Day on April 2nd, and then the announcement of the tariffs. What happens then is you're seeing less ships in mid-May and less ships starting at the end of April. What this leads to, and this is from Apollo Global Management. They're the ones who broke this down. And I thought they did such a good job, is why I'm repeating it. What it leads to is that then the trucking and the railways, they start to see a slowdown in late May. So that's probably coming just a few weeks from now because the ships have already started slowing. And so trucks and railways will start slowing next. And then sometime in late May, maybe early June, you start to see empty shelves and slower sales. So for example, we do construction. Go to any flooring place and go look to see where all flooring is made.
China.
It's all made in China. Like all of it. And so if you have a construction project, get on it now. Okay, because it's going to get more expensive.
More expensive because inventory is going down. Demand is still the same.
Yes.
And so, but I guess, I don't know if this is derailing you a little bit, but how does deflation come into play?
We'll get there.
Okay.
Yeah, no, but it's a great question. So all of a sudden you start ending up with lower inventory levels. You have less on the shelf. And then what happens is retail start to drop sometime in early June, and trucking starts to really slow down in early June, which leads to recession in the summer, which leads to deflation, just like you're saying, in the summer. Now, all of this
summer,
this summer, all of this is predicated on tariffs, though. And remember, this was flipped with a switch. And so it could be flipped off with a switch. This is why I want you paying attention. This is just creating economic uncertainty. It's why the S&P 500 dropped a whole bunch and then it rode itself most of the way back up. It's why the US dollar went down. It's why the Treasury yield spiked right after Liberation Day, and yet they've started to calm down over the recent basis. If you look at Polymarket, the odds of a recession right now are up to 65% in 2025. For those of you that don't know, Polymarket is a giant betting market. This is the gamblers telling us what they're doing. But I like looking at Polymarket because it's usually pretty good raw data. They predicted the presidential election amazing. So the recession hits, then the deflation starts. But all of this is still preventable because it's a switch. So we're just going to keep watching. The subscribers, you're going to keep listening. Drop your questions below. This is an all hands on deck because this is also creating massive opportunity inside of the fear. We'll get to that part later. These logistics, what happens is the logistics costs remain sticky for a moment. In other words, shipping costs and railway costs for a moment, but then all of a sudden everyone starts undercutting themselves. And the same thing applies to the suppliers. Nobody wants to sit on 10,000 phones, and nobody can sit on like 10,000 pounds of rice or 10,000 pounds of corn. So they start cutting the prices, and that becomes that deflationary impetus that then drives us into one, of the major problems: recession, stagflation. Soft landing's off the table right now. Let's be honest. It's not soft landing. It's a muddy, murky landing where you were praying to God you made it through the malaise. That right there is probably your best case scenario, but recession odds are getting very high. So the Fed now is stuck in this idea of this no-win situation. The Fed is in a lose-lose situation. The Fed's being called out Stones are being thrown at them. You've got the public sector, the private sector saying cut rates, and then the Fed saying we're data dependent, we're not ready to do it. It also feels a little political. It feels like you've got Trump on one side and Jerome Powell on the other side, just kind of bashing heads together. And the Fed's current fund rate is 4.25 to 4.5. And growth is slowing, but they're saying inflation is still persistent. And you can go and look at the CME Fed Watch tool, and you can see that the market is starting to price in cuts, but the Fed is giving no indication of cuts. Why? Because they're saying they're still truly independent. And what I'm telling you is that right now, the Fed is behind the 8 ball, and they're saying, oh, it's only soft data. It's got to show up in the hard data. If this domino sequence plays itself all the way out, they will be 90 to 120 days behind the data, and they will have to cut even further. Benji, this could lead us to 0% interest rates if this gets too far. This could get us back to a 4%, 3% mortgage if this gets too far.
Wow, like 2 weeks went by and this is like crazy.
Because it's breaking. You have to look at the economic data. You can see it breaking. You can see jobless claims going up. You can see the number of job openings going down. You can see consumer confidence getting worse. You can see the producer price index, them talking about the uncertainty inside of their future. You can see inflation fears are rising. It's all bubbling together. I'm not saying this is going to happen, but that is an official channel on the multiverse right now. You've probably got 25% odds. What's happening is when you look at it, they go, oh, we can't let inflation spike, but they're going to wait too long. So PCE just came out in March. The Fed's favorite metric. PCE was 0.03 in March, in line with expectations. This is freaking yesterday, this data came out. February was revised up, so it kept the 12-month rate at 2.6. For core, headline 2.3. So the Fed's favorite metric, both headline and core, are both trending down and getting to the mid and low twos. Now, if it's in the mid and low twos, for me, I'm like, okay, we made it. But the Fed's still saying, we're not there yet. We don't know how the tariffs are going to impact. And this is soft data, but the consumer behaves a different way. So they're going to wait until the hard data shows up and we're backed into a freaking corner. What else did I want to throw out here? Oh, then Besant was just on Fox. And he starts, this is what I mean, they're lobbing the stones. They're throwing them at good old Papa Powell. We are seeing 2-year rates, aka the 2-year Treasury, are now below the Fed funds rate. So the market is signaling the Fed should be cutting. And in this chart, you can see that the spread between the 2-year Treasury and the effective rate of the Fed funds rate is trending in a negative direction. As this trends in a negative direction, it's the market indicating as a forward-looking indicator the Fed should be cutting. That's what it's telling you. So Besant, even though he said, I'm not going to comment on fiscal policy and the Fed's autonomous and we're not going to tell them what to do, well, he just came out and just told them what to do. He said, you guys need to cut. They're not going to, though. So in May, the odds of them cutting are like 0. Then the bad data is going to start to show up, and we might, like right now, there's like a 35% chance of a 1/4 point in June, which means you got to get all the way to July to maybe get a 1/4 point cut right now, or August. These problems, this lack of inventory, our consumer-based economy, the seeds of deflation will already be sown, and possible stagflation, all these problems, if they don't, which means they have to cut harder and faster. I don't have a crystal ball. I don't know where this is going. I can just tell you this is getting bad. And that's what's going to create the opportunity. So we've been making offers for our buyers here in Seattle. And here's what we're hearing. We're seeing slightly less activity. And we're hearing, well, my stock portfolio is down. My job at Microsoft is just a little more uncertain. My job at X tech company. So it's causing it to slow down a little bit. So over Easter, and P.S., if you ever want a smoking deal, buy it a holiday. We got this young couple a smoking deal on this property over Easter. It was only shown like 8 times. It was still a massive bidding war. Our client had to do $100,000 non-refundable earnest money. It's going to close next week. The ARV, the as repaired value, 1.6. Got the property, $1,075,000. $250 to repair it, you got $250 in equity or $200 in equity. Rock and roll. That's because the economy is slowing down. That's because people are becoming a little less uncertain. I believe that Trump will step in and probably put this fire out. But if they don't, and egos get in the way, and the tariff battle gets in the way, then this could lead us to a recession and possibly a deflationary cycle or stagflation. That's the risks here. And the soft landing still on the table. You got a 20% chance today. It's getting worse. It's a muddy landing right now. And so I want you to be thinking as we kind of close through this mindset. And the mindset is chaos creates opportunity. And that Warren Buffett talks about this idea of be greedy when others are fearful. Personally, I'm making more offers on investment properties right now. We're just looking for more longer term things. We're asking for longer feasibilities, longer due diligence. We're making it subject to more items such as permits or financing. We're getting more owner financing. This is when you can go ask for things you wouldn't normally ask for. For sellers, it's really going to depend on whether you're relocating or not relocating and the price bracket in which you're relocating into and the city that you're relocating into, as today may or may not be the right time to sell. We had a conversation yesterday with someone about their multifamily. And for them, it's not the right time to sell because they are going to sit on the cash. And they're then going to use it for some family events, long-term care, and some other things. And so they need the max cash out of that multifamily. And so we actually decided, you know what, we're going to wait for rates to come down because I believe rates are coming down. It's just the question is the totality by which rates are coming down. And as rates come down, we know that boosts multifamily pricing because it helps cap rates. Buyers, you need to find the motivated sellers. You need to find the seller like we just did. Why did it go on Easter weekend? Well, it's actually supposed to close tomorrow. But I get a text message and it says, the property has been foreclosed on. And I literally go, what the WTF? Like, seriously. And I go, no way. We looked at that title report. We opened the title report. We looked through it. No foreclosures listed on there. So I calmed down, stopped my hands from sweating because I'm worried for my buyer. Text back. I'm like, are you sure that's what's happening? Like, I don't see a notice of trustee sale. Oh, it actually just received the notice of trustee sale. And I'm thinking, you idiot. That's way different between it's been foreclosed on, the seller no longer owns it, and we received a notice of trustee sale. So what actually happened was we found a motivated seller without knowing it, who was behind on the mortgage because it was an estate sale, who was receiving a notice of trustee sale. That's why they sold it quickly. And they still got a bidding war, but if they would have kept it on for like a week and not over Easter, they would have probably gotten it even better. So you can find motivated sellers. And this is in a phenomenal location right next to the Burt Gilman Trail, like right above Lake Washington. Like, this is a hot area. So there are deals even in hot areas. Another thing, like, if you can't find the deal, you got to go hunt it down off the market. Business owners, you got to cut dead weight. This is a conversation I had with 2 business owners this week. I said, you need to go fire 5% or 10% of your underperforming workforce. And they gasp. I said, well, let me ask you this. Which direction is your revenue currently headed? Is it flat or down? And they're like, one said flat, the other one said down. I said, okay, can you keep your overhead the same? No. So am I telling you anything you haven't already heard or haven't already thought about? Yes, but I love these people. We don't want to get rid of them. Once again, another small business. So you got to cut dead weight. You got to start renegotiating your vendor contracts. You've got to lock in good financing now. And investors, real estate people, real estate investors, business owners, stock traders, we got to be adaptable because we're in a situation where we have uncertain times. And what a lot of people do is they'll freeze. Well, you need to be moving. You need to be nimble. You need to be able to change your plan. And for our traditional people, stock up on a little extra cash right now, spend a little less. The recession fears, and remember, I'm an optimist. My recession fears are higher right now than they have been. That's not preventing me from purchasing real estate, but I'm back to cautiously optimistic with a view that rates are coming down later this year. And of course, then you'll see home sales pick up. This lack of supply is rampant. That's not going to fundamentally change housing prices, except for in a few of the other metros outside of our Seattle metro that are hit, like Austin and Florida and parts of Utah. But be adaptable, be on our feet, be listening to economic news, reading economic news, and paying attention, because as the hard data starts to show up, watch the Fed's reaction, watch the dollar, watch the 10-year treasury, watch interest rates, watch the stock market. And if all of it starts moving in bad directions at the same time, it means we're experiencing economic shock. Now, if they flip the tariff switch and close it down, and we start getting like one negotiation after the other, and they're all positive, this could calm down very quickly. I'll tell you today it's bad though. Like today I'm a little bit more worried.
And if the tariff war doesn't stop and it continues to slow everything down, and then business owners have to, like you said, cut the fat, they have to make decisions to just be on survival mode, unemployment goes up.
Yep.
And affects people's finances, everyday people's finances. Won't this be a trigger for lower home prices potentially if it was to ride out through the end of the year? Even with demand being high and inventory low, it's like that guy that was in foreclosure you didn't know was in foreclosure, that your buyer was buying it. Wouldn't there be more of those happening?
There will be potentially more of those. But the current foreclosure rate is so low, it's not enough to make a dent.
What's the timeline for foreclosures to start denting?
What would happen is if we go into a recession in the summer, you would start to see a potential rise in foreclosures in fourth quarter of 25. But really, that would start to show up in first and second quarter of 26.
Got it. So that would be a next year kind of thing.
That would be a next year.
Yeah.
And we'll be watching the data for them, like we always do. So hey, hit that magic subscribe button, drop those comments below, and let's keep watching together, and let's find some opportunities.